BP, the FTSE 100 energy giant, has dramatically reshaped its environmental strategy, signaling a significant shift away from its previously ambitious low-carbon goals. In a move that has sent shockwaves through the industry and raised eyebrows among environmental advocates, the company announced a substantial reduction in its green investment plan, slashing over $5 billion from its previously committed funds. This bold decision comes amidst intensifying pressure from shareholders, eager for a more immediate focus on profitability in the face of fluctuating oil prices and a challenging global energy market. The revised strategy represents a stark contrast to BP's earlier commitments. The company now plans to significantly increase its oil and gas production by 2030, targeting a staggering 2.4 million barrels per day, nearly double the output envisioned in its initial net-zero roadmap unveiled 5 years ago. This dramatic upward revision of production targets underscores a renewed emphasis on maximizing short-term returns, a strategic pivot that prioritizes shareholder value over long-term sustainability goals. The shift marks a clear departure from the enthusiastic reception initially afforded to BP's green pledges by environmental organizations. The company's share price, however, has told a different story, prompting a reassessment of its strategic priorities. The pressure on BP is not solely emanating from shareholders. The company finds itself locked in a high-stakes battle for its future with Elliott Management, the formidable activist hedge fund. Elliott, having amassed a substantial stake in BP, worth nearly £3.8 billion, approximately 5% of the company's shares, is exerting significant influence, advocating for a strategy focused on immediate financial gains rather than long-term sustainability initiatives. This intense pressure from a powerful financial player further underscores the complexities and challenges inherent in balancing environmental responsibility with the demands of the volatile energy market. To bolster its financial position and fund its revised strategy, BP intends to embark on a significant asset divestiture program. The company plans to offload assets valued at approximately $20 billion, a portfolio that could potentially include major components of its business. This sweeping sale could encompass its Castrol Lubricants division, a globally recognized brand with a long history. Its extensive network of service stations, a critical element of its retail presence, and even Lightsource BP, its renewable energy subsidiary, a prominent player in the solar power sector. These potential divestments highlight the magnitude of the changes underway, suggesting a significant realignment of BP's core business and a prioritization of its core fossil fuel operations. Simultaneously, BP intends to implement substantial cost-cutting measures across the organization. The company plans to reduce overall investments by up to $3 billion and slash operational costs by up to $5 billion by the end of 2027. These aggressive cost-cutting initiatives underline the urgency of BP's efforts to enhance its financial performance and address the concerns of its increasingly assertive shareholders. This multifaceted approach, combining asset sales and extensive cost reductions, aims to shore up BP's financial foundation and provide the resources needed to pursue its revised, more oil and gas-focused strategy. The consequences of this strategic shift remain to be seen, but it undeniably represents a watershed moment for BP, raising significant questions about the company's long-term commitment to environmental sustainability and the broader challenges faced by energy companies navigating the complex landscape of climate change and shareholder expectations. The future trajectory of BP, once a vocal advocate of green energy transition, now remains uncertain, subject to the ever-evolving dynamics of the global energy market and the persistent pressure from activist investors.